This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It's my pleasure to welcome Anton Ivanov. He is a full-time real estate investor now. He's got a software app he developed we'll hear about. Got a military background, and he's developed a great portfolio of about 35 units, so we'll kind of go into a case study. And he's done a few different things in the real estate investment industry, so it's great to have him. Welcome. How are you?
I'm doing great, Jason. Thanks for inviting me.
Good to have you. And Anton, you're in San Diego, right?
I am now.
Fantastic. How did you become interested in real estate investing?
So actually, I basically got thrust into real estate sort of against my will under some unfortunate circumstances. I joined the U.S. military, the Navy specifically, right after high school, and I was serving in Japan overseas. And right around that time, both of my parents passed away, and they happened to own a condo that they lived in San Diego, California. And I basically became an accidental landlord. So I inherited that property from them. Back then, I was early 20s. I didn't know much and definitely did not know really anything about real estate. I almost ended up selling the property at the time just because I was overwhelmed with everything that was going on. But thankfully spoke with a few of my mentors, older folks. They convinced me, hey, why don't you just not make any rash decisions, rent this property out. And then when you get back stateside, when you leave the military, just see how it goes and decide to sell it then or not.
So you are the real story of the accidental landlord, landlord by default. Yeah. Okay.
Looking back, I'm very happy that I kept the property. It didn't, kind of change my life financially by itself. It's kind of was trickling a little bit of cash flow every month, but what it did is really open up my eyes to what real estate can do for you, specifically as a passive income source. I was working in the military. I started reading books about personal finance, and I really got on the idea of early retirement. That kind of really struck to me. I could not see myself working for 20, 30 years and some corporate office desk. So really was interested in that. And obviously real estate is a very unique and powerful investment vehicle, in my opinion, that can help you both, increase your wealth through capital appreciation, debt pay down, and then obviously generate passive income. And, it all started with that one property that I inherited.
Well, yes, unfortunate circumstances, but you turned it into something great. So that was in about 2008, right? So about 11 years ago?
That's correct, yeah. So I was kind of midway through my naval career at the time. And then fast forward a few years, I moved back stateside, back to San Diego, got out of the military, got a more normal job in the software development field. Still had the property, and that's when my wife and I actually decided, hey, real estate is really the way to go if you want to build your passive income stream. And we set an initial goal to buy 50 units in total. We didn't really have specific like single family or multifamily. We just wanted 50 units.
50 doors, okay.
50 doors, and we figured around, $200-$300 of cash flow per unit per month. That would be about $150,000-$200,000 in yearly cash flow. And we kind of had modest goals. I guess we didn't need like millions, but we felt that level of income would allow us to retire early. And that kind of became the goal that the rest of our journey followed too.
So you had some frustrations, I'm guessing, with real estate investing, and that led to some technology that could help you analyze deals, right?
Absolutely. So then actually kind of some years into my real estate investing career, obviously before you buy any property, you need to analyze the cash flow projections. It's it's kind of, if you're not doing that, and I hope everybody who is listening is, it's akin to gambling at that point. So obviously we all need to do it. And like many other investors, I started with using Excel spreadsheet that I kind of quickly put together to run some numbers. I was a software developer, and I was thinking that there's got to be something better that maybe I can use on my phone or my computer to help me quickly run analysis, get my returns, make a quick decision. And didn't find anything, so I ended up building the first prototype of the DealCheck mobile app myself, and that progressed through the years. And happy to say now it's one of the most popular property analysis platforms on the market with over 75,000 users.
Wow. That's fantastic. Yeah. Tell us about analyzing a deal. One of the things I did when I got into this business back in 2004, I mean, I was in the real estate business before that, but strictly the investment side of the real estate business starting in 2004. One of the things I did is I standardized the data. And I think that was a really good decision because I found it so frustrating. Here I am, I'm researching like crazy. I'm researching all these different markets around the country. I'm flying to these markets. I'm meeting with people. I couldn't get any help. It was just the people you deal with in real estate. It's just a totally mixed bag. I'm sure you know that.
Yeah, absolutely.
And, most real estate people, they don't know anything about investing. They just sell houses, right? And so I found a software called Property Tracker back in 2004, and I started using that, and I loved it. And I just standardized the data. You got to have a benchmark. You got to standardize the way you analyze things so that you don't have to be a detective on every property, So tell us about analyzing properties and what investors should look for and, what they should watch out for too.
Yeah, I'll kind of keep this, obviously there's a lot of different deals and different investors, be that multifamily, single family, renters, those who want to buy rental properties or flippers will look at different numbers. But there's a few kind of common factors that I see over and over again that I love to point out. The first one is, no matter what tool or calculator or Excel spreadsheet you're ultimately using, it's only as good as the actual input numbers that you provide. And, a lot of times, especially out-of-state investors, they use very kind of crude or basically unresearched estimates, in my opinion, to plug into their calculator. And in my experience, garbage in, garbage out, so to speak, if you use inaccurate projections, extremely rough projections, or numbers to input into your calculations, you're going to get very, very rough or inaccurate projections out. So
and a lot of it is just wishful thinking,
Absolutely. I mean, at that point, you're kind of guessing. If you can't justify why I'm putting 10% for vacancy or 12% for maintenance, the numbers you get are really just guesses. And that to me is the key. And the only really sure way I found to start putting accurate numbers in your cash flow or profit projections for flips is to really know the local area, either personally or by knowing other investors who, live there, who invest there, maybe property brokers or agents, like you said, although they can be hit and miss. But that's really comes as a key. Every time I go in a new market, a new property type, a new area, I first spend a considerable amount of time learning the area, looking at dozens of properties, speaking with other investors in the area to get more accurate idea of, okay, what are my typical vacancies are going to be? What is my typical rent going to be? What ages are the properties there, and kind of derive the potential maintenance or capital expenditure costs from that. So, that's kind of always been my biggest pet peeve is, you hear a lot of investors use like the 50% rule, for example, to quickly estimate expenses. And maybe it's great for doing a very rough analysis, but in my opinion, it falls very short if you're actually serious about buying a property. So you absolutely have to, look up rent comps to get accurate rent. You have to look at other properties, maybe another investors own, to look up vacancy and so forth. So really you need to use, as accurate as estimates or projections or actual numbers that you can.
There's two sides of this then. There's the input data, the data
Absolutely.
you put, but like the old saying in the computer world, right? GIGO, garbage in, garbage out, right? So you got to get the right input data, but then using the tool and knowing what to look at, what to value and what not to value so much, right? For example, I'm not a big fan of cap rate. I don't think that's a very good metric. Yet in commercial real estate, you talk to any commercial person and, they live and die by cap rates, but it leaves a lot out that is very attractive for residential income properties. That's the thing, and people miss a lot of stuff in the income property world, because what I've said for a long time is some people are winning, but they think they're losing just because they simply don't know how to keep score properly, and you have these multidimensional aspects to a real estate deal where, it's kind of like the old metaphor of the iceberg. A lot of it's under the water and you don't really see it. You see the cash flow or the negative cash flow. Hopefully you don't have that.
Exactly.
But you don't really see some of the things that are really adding to your return and making your investment a lot better than you think, So what to value, how with the input data, talk to us about that a little bit.
Absolutely. So after the input data is accurate, like you said, you need to figure out what metrics to focus on. And it can be overwhelming for a new investor. You go to a typical calculator or online, people talk about probably at least a dozen common metrics.
Right.
We're talking cap rate, cash on cash return, ROE, return on equity, return on investment, annualized return on investment. So ultimately, I very much agree with you, Jason. You have to pick a few metrics to focus on, but not because they're popular. I fully actually agree with you about cap rates, especially in residential real estate. It's a very popular metric. In my opinion, it's somewhat misleading.
It misses. It really is quite misleading.
It's not very useful. Mm-hmm. So, there's two things, in my opinion, to that. One is really understanding what the metrics are and how they're calculated. You can look that up online in a few seconds or read a few articles. At least understand what a cap rate is, what is a cash-on-cash return, what are the underlying numbers. And two is look at your goals. What are the goals of you of purchasing the property, and find the metrics that align with those goals. So in my view, my primary goal is cash flow. So for any deal, actually the first two metrics that I focus on is cash flow per unit per month and cash on cash return. Mm-hmm. So the reason I focus on those two is, first, obviously, my goal of 50 units with about $200-300 monthly cash flow, to me, that takes me to about $150,000-200,000 in yearly cash flow. And that's really my ultimate goal. My primary goal for real estate is to replace my W-2 income, allow me to retire early. So naturally, that's the first metric I focus on. The reason I focus on cash return, because cash flow by itself can be misleading. I can spend $500,000 on a property and get $200 a month cash flow, or I can spend $50,000 on the property and get the same cash flow per month. Which one is the better deal? Obviously, the one I spent less money on, and the cash on cash return.
Or even better, the one you put less money into. Meaning
Correct.
You've got
Exactly.
more leverage, which increases your cash-on-cash return, right?
Exactly. Yeah. And that's my second metric, the cash-on-cash return. Like you said, the way you structure the deal, the price of the property and your ability to bring as little cash to it as possible will increase that return and really allow your money to work for you in the greatest possible sense. And then the final, if I had to pick my top three metrics, I actually focus on annualized ROI. So this is sometimes internal rate of return. And this is, in my opinion, the most all-encompassing metric that
IRR
takes into
is
correct. That takes into account.
That's the holy grail of metrics, internal rate of return. And it's hard to calculate, but now we've got all these tools that make it easy. Years ago, I learned to calculate IRR by hand.
Oh, wow. I wouldn't wish that on anybody.
Yeah, it's complicated, but the computer will just do it like that. It's so easy.
Right.
Yeah, go ahead.
Yeah, and that one really allows you, so now not only cash flow, but take into effect projected price appreciation and debt pay down, and basically give you a total rate of return on your invested capital that you're getting. And that's really the only metric you can also compare to, say, the stock market or other investment types, because it's all encompassing. And it's it does take into account some assumptions, like obviously appreciation, which is very hard to predict. And that's one of the reasons why I don't focus on that primarily, but kind of as a third metric to give me, hey, cash on this property, cash flow is great, cash on cash return is great. let's look at IRR, my total return on investment, and that can be used to compare, for example, different properties between each other, or even real estate to other investment sources, and really decide, hey, am I putting my money to the best use?
Sure. Yeah, very good. Hey, I'd like to ask you about your thoughts. Appreciation, it's the icing on the cake, if you ask me.
Right.
I have a feeling we share that view and feel the same way about it. But I'd like to ask you about your view of the future and the economy and the real estate market in general, and especially the renter market. It seems to me like landlords have a very good decade coming up with a lot of renters. It seems as though the stigma from being a renter has been removed largely. So people are happy to rent. It's not a big deal. And we've got, the millennial generation that is saddled with student loan debt like crazy. I like to say they have a mortgage. They just didn't get a house included with it. They're likely to be renters. They love their mobility. So being a renter makes you much more mobile. You can go to where the jobs are. It's I always say the best thing to have on a resume is mobility, be able to move to where the jobs are. So, it seems as though there's a real shift going on in the culture when it comes to renting, where it's okay to be a renter. Interestingly too, and this is an amazing component of it, baby boomers that are now empty nesters where their kids have moved out and they've got money. These are not poor people. They're selling their house and renting like in higher numbers than ever before. It's kind of an amazing thing. I think people have just discovered there are some real benefits and conveniences to renting, and many of them are building big investment portfolios. So it's not like they don't love real estate. They just rent their own home that they live in, right? So,
exactly.
It's just an interesting dynamic in how it's changed. So what's your view of the future, the real estate market, the renter market, et cetera?
Honestly, I am very much on the same page as you. I'm not kind of that old to kind of comment on a lot of older generations, but I have seen a trend where, if you kind of look at the ideal, maybe family or ideal lifestyle, 10, 20, 30 years ago, probably the top three, if not the top one, was home ownership. Mm-hmm. It was I have a family, we buy a house with that white picket fence or whatever, and kind of settle down. I felt that kind of the older books that I read and when I went to school, that was almost a no-brainer, was the home ownership, and everybody kind of strove to it. Mm-hmm. And like you mentioned, a lot of the younger people, or even people my age, in the 30s that I meet now, is just not really that big of a deal to them. I mean, they keep it in the back of their mind, and some of them do buy houses, but it's just sometimes not in the top three, maybe not even the top five. Yeah. So I feel, as a society, it has progressed, and maybe the home ownership just got, deprioritized compared to other traits, maybe more focused on your job and income or mobility, like you mentioned. Mm-hmm. All of this is perfect news for real estate investors. Mm-hmm. I mean, hands down, obviously I keep buying rental properties, and I'm very bullish on being a landlord. I don't think demand for rental properties will decrease. It's probably going to keep going up, and that puts landlords like us and other people listening in a very favorable position, and kind of promotes long-term wealth building and long-term security with the passive income.
So the renter market, we both agree, the future of the renter market is good. It's solid, maybe growing. That's good news. What about the real estate market in terms of price appreciation or depreciation? You're investing in the linear markets, and that's been my approach for the last 15 years. Before that, I was a Southern California guy. I was a speculator. I would buy in these high-end areas, Irvine, Newport Beach. These are very expensive areas. The cash flow doesn't make any sense. I thought I was an investor. I just didn't know any better, Yeah. And I did make some money, but that was more by luck than design. But now, I really like these prudent linear markets that cash flow. What are your thoughts on overall real estate market?
5 years ago, I met this guy who, funny you say it about Southern California, he owned 100 doors down here in Southern California. He had a business partner. Business was, booming. They were overpaying by $50,000, $100,000 for each property. Yeah. Negative cash flow, but, in a year they would make $100,000, $200,000 on each building. It was, the way he described it, it was just absolute craziness.
This, folks, is what I have called many times the greater fool theory. Yeah. That states no matter what I pay, some greater fool will come along and pay more.
Yeah, it was just, he said it was absolute insanity. 2008, 2009 hit. Him and his business partner both went bankrupt within a period of about 6 months.
Yeah,
and he kind of rebounded from that and recovered. But that story and others that I've heard similar to that really stuck with me. I could not agree with you more that I've met people who like these kind of coastal cyclical markets, like California or Upper East Coast. I could not.
Or South Florida too. They're gamblers. That's just gambling.
Exactly.
It's just not reliable. I mean, in all my years of doing this, I've never met anybody who can reliably predict the appreciation and depreciation cycles. So yeah, couldn't agree.
Right, and they all do well, like you said. When the market is going up, everybody's doing fantastic. As soon as we have a correction or a crash, where are those people now? Yeah. You don't see them around.
Everybody's a genius in a bull market.
Exactly.
Yeah.
Absolutely, exactly. So I'm a big proponent of cash flow, but at the same time, I would say that there are a lot of kind of Midwestern and kind of heartland of the United States, so to speak, markets that I won't buy in.
There's definitely some junky stuff in blighted areas. We were turned off on Ohio for a long time. We started recommending it. We got a few. There's some pockets that are good. For a long time, we wouldn't do Memphis, and since then, we've done tons of business in Memphis. Indianapolis has been great for us for many years. That's our longest running market. But, we have not been brave enough to touch Detroit. Some of my competitors do, and I just don't see it.
Yeah, my 2 cents is I really like markets that have good fundamental economics behind the city. So we're talking about positive job, population, and economic growth. I feel like if a city, has those, that will continue drive both the home prices as well as the rents up. Because the last thing I want to have as a long-term kind of buy and hold investor is stagnant rents, stagnant property values.
Right.
Once you factor inflation into it, increasing expenses, I'm going to end up losing money on that deal in 5 to 10 years, even if it looks good on paper now. So
I know, and that's the siren song. It's the deceiving thing in real estate. You look at an area like Detroit, and it's so blighted, and it's been blighted for decades. It's coming back a little bit. There's certainly pockets, like everything has pockets. And, you've got these super cheap houses and everything looks like a great deal on paper. But it's just a weird thing about blighted areas. If they come back, it's a very long and arduous process.
Yeah.
They do. I mean, they turn. Some of them do, but it just takes a long time.
Absolutely. And I really feel, that long term, it's better not to be kind of deceived or blinded by that high prospect of cash flow now and really think about, okay, what is my exit strategy, or even what are my returns going to look like in 5 years? Is my cash flow just going to be eaten away by inflation or expense creep? Is there going to be any rent growth? Is there going to be any price appreciation, even though maybe that's not your primary focus?
Right.
You definitely want to have that, as an investor, that will drive your total IRR up over the long term.
Good stuff. Well, hey, thank you for joining us. The website is what?
So if you want to check out DealCheck, analyze rental properties, flips, multifamily commercial buildings, you can use it online at DealCheck.io or download the DealCheck mobile app on your Android or iOS device. Free to use. Check it out. See if you like it. If you want to upgrade to one of the more full feature plans, we have a special promo code just for you guys. It's CW25 off. So CW25 off, get 25% discount at DealCheck.io.
Final thoughts on real estate investing?
It is probably the number one way to build long-term wealth and especially passive income. I have not seen a different investment that beats it.
I couldn't agree with you more. I always say it's the most historically proven asset class in the entire world. Anton, thanks for joining us.
Thank you, Jason. Great to be here.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.